Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. Against a backdrop of the tragic loss of life today from two wars, those between Russia and Ukraine, and now Israel and Hamas, our hearts are with all those who are suffering so terribly. The reaction of financial markets, by contrast, to the events this month has been relatively limited. The rally in the dollar and gold has been modest. Equities are flat, and while equity volatility has risen, it is still below the 5-year average. Oil prices have climbed, but by just 3% since the crisis began on October 7th. So why has the market reaction been comparatively benign? Probably because at present both conflicts, while inflicting huge suffering on the ground, have not yet had a strong impact on the global economy. The key issue for markets is, can this continue? The risks are clear. First, economic growth is fragile. A sharp fall in confidence could turn a slowdown into recession. Second, a further rise in energy costs could well trigger a second-round inflationary shock. This would require central banks to lift rates further at just the point investors are hoping they may have peaked. Third, the rise in military spending that is already occurring only adds to public sector deficits that are already widening alarmingly. Couple this with central banks that are winding down their huge bond portfolios, QT, and there is a risk that bond yields themselves could overshoot to the upside. We'll look at the implications for this in global portfolios in the slides ahead. So let's begin by looking at the performance of world markets in the left-hand panel for the year to date. Global equities up 11% off their highs, but still a very robust number. In the light blue line below, I've plotted that same index, but this time I've equally weighted all the companies, ignoring their size. That index is up just 3%, and that's the impact of the so-called Magnificent Seven US technology supercaps. And you can see also why their inclusion has put so much pressure on active managers who don't want that sort of technology weight. In red, the UK gilt market down about 5.5%, relatively stable over the last 3 months. So on the right-hand side, we can see the impact on equity volatility of events in the Middle East, and we've seen a very modest move. The VIX index ticking up just to 18.1, below the 5-year average, and nothing like the sort of volatility spike we saw during the COVID era. A similar message from other safe haven assets in the left-hand panel. The dollar climbing modestly, was rising before the crisis, up 2% for the year to date. A small uptick in gold, again modestly up for the year to date. So it doesn't appear yet that investors are hurrying into those safe havens. On the right-hand side, I've shown oil prices. Again, they've been trending stronger for the last 6 months on the back of production cuts from Saudi Arabia and Russia. Yes, we've seen a little bit more volatility in the last few weeks. In the red line there, I've shown also the Urals blend. That's the price that Mr. Putin's Russia is receiving for its oil. Now, G7, with its embargo, was hoping to hold that below $60. You can see that Russia is effectively selling to other markets and achieving around $81 a barrel. So let's look a little more closer at the impact on oil of previous Israel-Palestine conflicts. I've looked at the last 6 since 2000, that left-hand chart, and you can see in general oil prices come down into the crisis. But then extraordinarily, they don't really rally. There isn't a huge impact. Nothing like what we saw in the Yom Kippur War, where of course there was an entire Middle Eastern embargo that affected all global economies. On the right-hand side, there could be other effects on the oil price as the year proceeds. President Biden drew very heavily on the Strategic Petroleum Reserve, the SPR there in the line in blue, and he hasn't been able yet to replenish that. On the bottom line, you can see also domestic reserves in the US, very low for this point in the season. So we could yet see more upward pressure on oil, but no sign yet of an energy crisis. Let's look a little bit more closely at the dollar too. Well, traditionally the dollar performs inversely to the oil price. Oil rises, the dollar falls, and vice versa. You saw this in 2008, you saw this in 2015, where the oil price collapsed and the dollar surged. Over the last 4 or 5 years, though, that has broadly changed. In fact, when the dollar rises, oil tends to rise with it, or vice versa. In other words, the US currency is almost becoming a petrocurrency. Why is this? Well, the answer is very clear on that right-hand panel. That huge surge in dark blue of shale production, making the US possibly the world's largest energy producer and exporter. The other impact in world markets, of course, is going to be higher defence spending, probably around the globe as we confront these new geopolitical challenges. That's going to put pressure on what are already extraordinarily stretched government budgets. You can see in that left-hand panel, we've been quite unable to return budget deficits around the world. to anything like the level we saw pre the COVID crisis. In the US, we're expecting almost $2 trillion of bond issuance to fund President Biden's spending programs. On the right-hand panel, I've shown the impact of the Federal Reserve, who is also a seller of bonds as QE turns to QT. Put these two together and you get enormous supply pressure on bond markets, which is what I think is pushing US yields ever higher. That won't go on infinitely, but it does introduce volatility in bond markets and mean that perhaps one's got to be a bit more patient before one begins to harvest these higher yields. So what's this mean for bond markets? On the left-hand side, you can see UK corporate issues at around about 6%. This is attractive. We're adding to positions. The bond supply issue isn't quite as bad here in the UK. Not yet, though, ready to buy gilts. On the right-hand panel, you can see US T-bonds at 480 and price volatility quite high. So again, be cautious for a little longer before you buy into the US bond market. So what does all this mean in summary? Well, first of all, thankfully, given the scale of the humanitarian crisis, it's not being amplified in financial markets, which are relatively stable. We're underweight still government bonds, overweight corporates. We're underweight equities or neutral with insurance. We feel there is further downside there. And throughout this crisis, we're holding higher than normal cash balances. Well, I hope this session has been useful. I hope it's given you some idea of how to link geopolitical events and the tragedies of the Middle East to financial markets. Thank you very much.